Hello, welcome back to International Finance. Today's topic is the balance of payments. So let's jump right in. Last lesson and our last lecture, we went through an overview of the course. We did a very thorough review of the time value of money. This week, we're going to change things up a bit. We're going to look at the balance of payments, so the capital account. This is basically where trade, international trade is accounted for, and then the current account or the financial account. This is going to be where we account for financial investment. And then lastly, we'll talk about Brexit, which is a great case and a great way to understand how things can sort of disintegrate, how we can actually have a removal of the free flow of capital and investment between countries. Okay, so our present value equation, what you'll notice is that we don't see the balance of payments anywhere in that present value equation. In our numerator, we have free cash flows, and in our denominator, we have the WACC. That doesn't mean that the free flow of goods and capital between countries won't affect our value. Au contraire. In our numerator, we have free cash flows. Clearly, one of the ways that our balance of payments will affect our present value equation is through trade. So if we have import tariffs, if we have export tariffs, quotas, if we have free trade, if we have the ability to sell more or the ability to sell less, all of that is going to affect our free cash flow. The other way that the flow of capital and goods between countries is going to affect our value is through our denominator, through the WACC, our weighted average cost of capital. Ideally, if the firm is able to access a larger investor base, a wider group of investors, either shareholders from outside of the country, or you can get a loan from banks, you can find really good terms, etc. Hopefully you'll have a lower cost of capital, or at least access to multiple sources of financing to reduce your cost of capital. And then the third way that the flow of capital and the flow of goods between countries can affect our value, it's not through the numerator or the denominator of our value formula, but it's really through uncertainty. So we'll talk quite a bit when we get to Brexit about how the uncertainty of the event caused firms to behave a little bit differently. More generally, when we get into real options in about, I guess, a week or two, when we get into real options, we'll actually quantify when it's worthwhile for the firm to wait. So to ground ourselves, we have our owners, our shareholders, we have our investors, that's our shareholders, our banks, anybody holding our debt, and then we have our stakeholders. And our stakeholders include everybody. That's the employees, that's the managers, that's the investors, that's the government, that's the neighborhood in which we work, that's any institution or group that's going to be affected by the actions of the firm. What we'll observe when we talk about Brexit, and what we want to keep in mind as we go through our balance of payments, is that our different stakeholders are going to have different perspectives and different interests as it relates to the flow of capital. So that's something we always want to keep in mind, that different stakeholders are going to have different objectives and different interests, and it's going to be our job to make sure that we can work through those conflicts of interest to behave ethically and also to quantify the economic impact of the choices that we make. So let's get into it. What is the balance of payments? The balance of payments is the record of a country's international transactions. Credits flow into the country and debits flow out of the country. It's very similar to an accounting statement, but for a country. So in this example, we've got Japan and the US. One of the US's major exports to Japan is US aircrafts. One of Japan's major exports to the US are Japanese autos. So what do we have? Notice that we have a red arrow as the imported item comes into the country. That's because as you bring that item in, you have to send money out. So it's considered a debit on the current account balance. Notice that we have a green arrow on the items that are leaving the country. That's because as you send those items out, your exports, money comes back in. So those are known as credits on the balance of payment. So if I'm in Japan, the import of US aircraft is going to be a debit on my balance of payments, and the export of cars to the US is a credit on my balance of payments. And for the US, the exact opposite is true. If I'm in the US, my export of US aircraft to Japan is considered a credit on the balance of payments, and my import of Japanese autos is considered a debit on my balance of payments. So again, country A's debit is going to be country B's credit. And this is essentially an international accounting of all of the capital and all of the goods and services that flow between countries. So what actually flows between countries? Well, we have our current account, which are basically exports and imports, and we can have goods and services. So anything you can think of, it's exported and imported, I promise you. Construction, toothbrushes, movies, consulting, metals. We also have primary income. So this is going to be interest and dividends on investments that are made previously. We then have our financial flows. So these are going to be our savings and investments that move between countries. We have portfolio investment, and this is the typical way we think about buying a stock or buying a bond or buying an option, a derivative. And then we have foreign direct investment, what makes foreign direct investment so interesting is that we're looking at capital flows that can have a controlling stake in a foreign business. So we'll talk about this when we get into the capital account, but that's kind of what makes them. Generally, we think about an investment with like a 10% or more ownership, something that's going to give you the ability to control the foreign business. We generally think of that as foreign direct investment. Our last two things are going to be national reserves and statistical discrepancy. National reserves are forex reserves. Those are usually held by governments. And then the statistical discrepancy we'll look at in a little bit. Okay, so the first item on our balance of payments, our BOP, is the current account. The key idea is we have exports minus imports. The US has ran a trade deficit for, I think, continuously, virtually continuously since the late 80s, with the exception of maybe 1991. But the US has ran trade deficits continuously. What is a trade deficit? If a country exports more than it imports, the country runs a trade surplus. If the country imports more than it exports, the country runs a trade deficit. Why do we think of it this way? We think of it this way as exports minus imports because we're still kind of tied to this old formula for GDP, where we think of national income equal to consumption plus investment plus government spending plus exports minus imports. So that is where this is all coming from. If we have our credits exceed our debits, meaning that we sell more than we buy, we have a surplus. And if the opposite is true, then we have a deficit. The US has ran trade deficits continuously since the late 70s and early 80s, and we'll look at that. We also have exports and imports more generally. So let's kind of make sure we understand what I'm saying when I say exports and imports. An export is going to be anything that's sold out of the country to foreign residents, firms, governments, etc. And imports are going to be anything that's bought inside of the country from foreign residents, firms, governments, etc. So what is being exported and imported? Goods, aircrafts, cows, munitions, metals, movies, you name it, it's being exported and imported. We also have services. The export and import of services is growing incredibly important, especially in the US and in the UK. And when I say services, I mean anything from consulting to medical services to legal representation. And then lastly, we have primary income, the interest and dividends that we mentioned earlier. And this is interest and dividends that are earned on investments that were previously made. Let's look at the US's largest trading partners. So what do you notice? Hopefully, what you can observe is that there's a difference between the countries that we import and the countries that we export. So our largest import partners, China, Canada, Mexico, Japan, and Germany. What do you see for our largest export markets? Canada and Mexico. And hopefully that makes some intuitive sense. Those are our neighbors to the north, our neighbors to the south, very low cost to send our goods. You also observe China and Japan and the UK. So hopefully you can kind of get just the flavor from looking at that there's a difference between some of the countries that we import things from and the countries that we export to. So the markets can be a little bit different. Okay, let's look at changes in our current account. So these are percentage changes in US imports and exports. There are two things hopefully that you can observe as you look at this. To explain the graph, again, these are percentage changes, year over year, percentage changes in volume. So there are two things that jump right out. First, notice how these changes vary quite a lot. So there's a lot of variability with our changes in imports and exports. The second thing that hopefully you see, notice how the two lines move so closely together. They co-move. Within financial economics, we would say that they're co-integrated. So what does that mean? When things co-move or co-integrated, we're saying that they kind of share some commonality. There's some common factor that likely is closely tied with these two forces, with imports and exports. And honestly, what we'll hopefully look at in our example is that that common factor, one of those common factors is exchange rates. Imports and exports can be sensitive to changes in the exchange rate. So let's look at the capital account, or as the book refers to it, the financial account. The book is the only place that refers to this thing as the financial account. So we're going to stick with the capital account. Okay, the capital account. These are financial flows. So this is U.S. residents' sales of U.S. financial assets to foreign investors minus U.S. residents' purchases of foreign assets from foreign investors. So it's very similar to exports minus imports, but for financial assets. What are the types of investments? First, we have FDI. So FDI is when you have a controlling stake in a foreign business. As a general rule of thumb within the literature and within public policy, when we discuss this, we generally think of this as an investment of 10% or more of ownership within a firm. That also will include greenfield investment. So this is if the firm decides that it wants to build a brand new facility, or it has a sub. So if you're a parent and you have a sub, you want to expand into a country, you have a brand new investment. It's called a greenfield investment. And this also will include a foreign acquisition, where a firm is acquiring a controlling stake, wholly owning another firm in a foreign country. So those are all different types of FDI. And when we get into real options, we'll look at ways in which this question of when to buy and how is important. The other type of investments are going to be portfolio investment. So portfolio investment, this is buying a stock, buying a bond. Again, non-controlling stakes. So this is generally what we think of when we think of investing in foreign countries and just investing in general. We think about our portfolios and we're not trying to have a controlling stake of the firm. And then there are other investments like currency, banknotes, trade credit, the list goes on. So where is the money going? Let's take a look at the US's largest investing partners. On the left, we've got direct investment. So remember, these are the investments that have a controlling stake. Inward direct investment, this is the investment that's coming into the US. So where is the investment that's coming into the US coming from? Japan, the United Kingdom, Canada, the Netherlands, and Germany. Those are the top countries that have direct investments into the US. Outward direct investment, that's US direct investment in other countries. Where is that going? The Netherlands, the United Kingdom, Luxembourg, Canada, and Ireland. A lot of US direct investment overseas, at least corporate direct investment, a lot of that sometimes is in production, where you'll basically set up a sub in another country and you really want to make sure that you have low taxes or patent protection or something like that. Let's look at US portfolio investment. So total investment, we can see it's 13 trillion, that's a large number. And where is that actually going to? Where are the assets being invested in? This will surprise you. The largest destination for US portfolio investment is the Cayman Islands, 15%. Then it's the United Kingdom, then Japan, Canada, France, and Ireland. So what do you observe? Well, the Caymans, a lot of that is financial investment. So we would think of that as essentially a low tax area. It's really welcoming for financial services. So we have hedge funds, insurance, reinsurance. There's a huge financial sector within the Cayman Islands. Okay. So the last two items that we have on our balance of payments are the statistical discrepancy and the official reserves, the national reserves. So if you look back on slide 6, item 8, notice there was a negative 40.5 USD billion in 2018. So what is that? That comes from the international payments and receipts coming at different times, and also sometimes with slightly different accounting methods. And most of that is going to be due to financial transactions. If you think about this, hopefully it'll make intuitive sense. If I sold you a stock in January, but now it's February, the prices that we record for the stock might be different. If I'm taking the price that I sold it to you in January and you're taking the price of the stock in February, those prices are going to be different. So a lot of that differencing and when and how we account for the financial transactions can lead to these statistical discrepancies. The last item are national reserves, and these are government transactions that are used to intervene in the Forex market and to meet balance of payment needs. Typically, this is going to be gold. So a lot of this is gold. Forex, you'll actually be holding foreign currency. And then there are other items that are more unique to your relationship with the IMF, special drawing rights, and IMF reserve positions. So governments will use Forex and gold reserves, they'll basically use their national reserves as a way of either keeping the currency lower valued or of supporting the currency to have a higher value depending upon the government's objectives with economic growth, investment plans, and lots of different things. So let's take a look. What happens as the flows occur? So as US residents buy imports, they'll be supplying Forex to the market. Specifically, they'll be supplying dollars to the Forex market. The intuition is that you're spending USD to buy stuff, but the places that you're buying from want local currency for their goods and services. So you supply dollars to the market. Okay, pause for one moment and think with me. Suppose that the exchange rate were to rise. What would happen? If the US exchange rate increases, then imports become cheaper and you'll attract capital inflow as investors will be looking for places that are going to have a higher preservation of value. So exchange rates rise, imports become cheaper, and you attract capital inflow. Okay, what happens as we export? As US residents sell exports, foreign firms are demanding USD from the Forex market. And the way to think about that is think about your own life. Same idea. If you're working, you're employed, you want to get paid in dollars. So in order to pay you in dollars, a foreign investor or a foreign firm or a foreign government is going to have to go to the Forex market and demand those dollars to throw at you in exchange for whatever it is that you're selling. So it's the same exact idea. Now, pause for a moment and think with me. Suppose that the exchange rate were to fall. If the exchange rate falls, what do we expect? We expect that exports are going to become cheaper. We also expect that there's going to be less foreign investment. So there's going to be capital outflow. Why? Well, this goes back to something we talked about in our intro lecture. If we have a whole return that is devalued because of currency devaluation, even if we have a positive capital gain, if we see price appreciation, if our currency is devalued as an investor, it can wipe away our return. So investors are going to be responsive. We assume investors are going to be responsive to appreciation in the currency. They're going to want to come invest. And when the currency depreciates or devalues, they're going to want to take their money out. And that's the exact opposite of what we're talking about with exports and imports. We said that when the currency appreciates, imports are going to become cheaper. And when the currency depreciates, we're going to think about exports becoming cheaper. So the last thing we mentioned were the reserves. And what does that do? Hopefully you can see from the graph this intuition. As the government sells dollars into the market, they're increasing the supply of dollars. in the Forex market. So the reserves are a mechanism for keeping the exchange rate either high or low or stabilized. Again, it's really hard to be general because so much of this varies with the country's own economic objectives. But the hope is that in seeing the graph, it can feel a little bit more intuitive how this works, that the governments will use reserves as a way of achieving policy goals with exchange rates.